Hello, everyone. This is Michelle Lee. I'm a partner in Thompson Hine's International Trade Group. Welcome to today's SmarTrade Fundamentals webinars on custom valuation. This is the third session in a five-part series focusing on the basics of import regulations and customs compliance. Today's session will review the methods of valuation, common pitfalls, and recent developments in CBP's enforcement. Attendees will leave with strategies for documenting and defending valuation decisions. Before we begin, I must address a few housekeeping items. First, today's program is being recorded, and we will send a link to all attendees of today's presentation in the next few days. Second, this presentation is intended for the general information only. The thoughts and opinions being expressed today are those of the individual panel members and do not necessarily reflect the opinions of the panel members' clients, employers, affiliates, or Thompson Hine. The content should not be taken as legal advice, as the views expressed are for information purposes only. Now, third, if you have any question during the webinar, feel free to use the question box located in the control panel on the right side of your screen to submit questions. We will answer those questions as we can, both during the presentation and at the end of the webinar. If we can't get to your question today, we'll follow up after the program. Fourth, we will be offering CLE credit for today's webinar. Please be sure to complete the survey after the program. A link of the survey will be included in the agenda that can be found in the related content section of the control panel. There is also a direct link to the attendance verification survey. I will announce the tracking code at the end of the program. Fifth, in the related content section, you can also download a copy of the PowerPoint slide today, as well as the bios of today's speakers. Now, today I'm joined by John Madridge. John is the Senior Director of Audit Services at the DeLeon Trade. Again, thank you for your interest, and we will get started. John, why don't you get an introduction of yourself to the audience?
Sure. John Messer, Senior Director of Audit Services, DeLeon Trade. I was 11 years at Customs and Border Protection and Regulatory Audit as an Assistant Field Director. I also taught valuation at the Federal Law Enforcement Training Center to all auditors that came on board at Customs. So I've taught a couple hundred auditors how to do valuation. That one's a 3-week course. This one's just about an hour. So we've cut a lot of content for time. So, Michelle, I don't know if you want to do anything else before we get started?
No, that's perfect. Why don't we just get started?
Okay. And you could see like 2025 is taking an impact. Like that photo there is me pre-2025, and now I lost a little more hair and I'm a little more gray. The 2025 tariff effect is what I like to call it, right? So valuation, why are we here? Why do we care, right? Well, now more than ever, valuation is driving duty impact on goods. Before, classification was super important, and not that it isn't anymore, but now valuation is driving everything, whether we're talking about ad valorem general duties, Section 232 on aluminum, steel, copper, you name it, right? 301 duties on China, anti-dumping countervailing, IEPA reciprocal, IEPA fentanyl, HMF, MPF. It's the key component of any good customs compliance program, and foundationally, it's more important than ever. And in addition, it's important from the CBP inquiries that we're seeing.
So what mechanism have you seen CBP using recently to conduct valuation reviews, John?
Well, I've seen a ramp up on valuation-specific questions in CF-28s, especially, where they're asking a lot more about the relationship between the entities. So on related party transactions, they're asking more questions. We're also seeing a lot regarding first sale transactions, which I'll get into a little bit later. But that's where some of the areas of valuation now very important because it's driving all the duty, right? And CBP's been doing lots of 28s, like I said, and quick responses to that, issuing 29s if the 28 response is not satisfactory. A lot of the times this starts with, sometimes there may be even before the 28, a question of the broker where they say, upload these documents via DIS. They take a look at them, they issue a 28, sometimes a 29. It ramps up pretty quickly at times. Also on the audits, very heavily focused on value. They always were, but now even more so when we're talking about areas such as first sale, related party transactions, additions to value. If anyone's ever gone through an audit before, they issue a pretty big questionnaire, and there's lots of questions about additions to value, whether it be assists, supplemental payments, you have it. Also see this big ramp up in investigations, not necessarily just in valuation, but in general. CBP has come out and said they're doing more investigations. I've had clients in an industry where I've had 5 clients get contacted and be under investigation in the same week in an industry. So CBP is really ramping up that effort. And really, and then the penalty side, valuation is a key aspect in determining appropriate penalties if CBP goes that route.
Yeah, I was going to ask you that is there a specific or general kind of timeline between a company receives a CF28 to the custom enunciates, oh, you're going to get into investigation. My experience is there is not. There was one of my clients, our clients actually jumped right into investigation because they kind of missed a couple of deadlines that custom gives for certain questions. So is it your experience that CBP is actually ramping up and jumping right into investigation, ignoring all this previous kind of set of practice about sending you a CF28, then you get a CF29, then you get back and forth and get into a formal investigation?
Yeah, we're definitely seeing investigations that are essentially initiated outside of a CF28. They're essentially, CBP is looking at industry data and they're saying, okay, we have this issue in this industry. We're going to announce investigations on these X number of companies. And I know it's a lot in certain areas, but we have definitely seen that where CBP has sort of skipped the 28 process and they think they have enough to go on. Unfortunately for importers, some of those that get the investigation announced, they may not even have an issue. Just the data looks a weird way to customs and they announce it. But you're kind of at a disadvantage with customs when you start under investigation.
Yes, totally agree.
So topics for today, right? I can't cover everything on value, but I want to talk a little bit about the hierarchy, elements of transaction value, some potential exclusions, the additions to value, the commissions, royalties, assist, packing, proceeds, those kind of things. I want to talk about some considerations with regards to related party transactions. Also want to talk a little bit about elements of first sale, because that's a big topic right now. Reconciliation, important to many importers in their import valuation program, and then a little bit about internal controls at the end here. Because fundamentally, without controls, it's very difficult for an importer to be compliant.
100%.
So first topic, customs valuation hierarchy, right? It's a hierarchy. It's not a menu. An importer cannot specifically just say, hey, I want to do computed value because it's going to result in less of a value than if I use transaction value. It doesn't really work that way, right? Transaction value has to be used unless there are some factors present in the transaction that specifically rule it out from being acceptable. So, for example, transaction value is based on the price actually paid or payable plus certain additions, right? And one of the requirements is that there has to be a sale, right? And so in instances where you may be importing something on consignment, where it's not actually sold at the time of importation, that would be a reason that it kicks you out of transaction value and you go to the next basis of appraisement. And then that's identical or transaction value of identical or similar merchandise. This one's frequently not used all that often, but it's essentially based on a transaction value of previously imported merchandise that was imported at or about the time of the shipment in question. Not too often do we use that. It's used occasionally. Then if you don't have transaction value of identical or similar, you jump to deductive value, which is kind of difficult to use in practice. It's the selling price in the U.S. in the greatest aggregate quantity, less certain post-importation costs, whether it be a commission or a general expense and profit. It's kind of hard to execute in practice. And so there's one deviation in the law that allows you to use computed value in front of using deductive value. That's the only sort of way you could supersede the hierarchy. And in computed value, you start with the foreign supplier's cost information and you put together materials, processing, profit, general expenses, USS's packing, these elements of computed value. We frequently see computed value on maquiladora importations from Mexico because, there's not usually a sale at time of importation. The U.S. owns all the equipment. They own all the materials. They pay in lump sums to the factory essentially to keep things running. And those are usually appraised under computed value. And you could see there's a CF 247 online. It's called a cost submission. And that's kind of the foundation of using computed value. But we typically see that in maquiladora transactions from Mexico. And then if you don't fit any of those bases of appraisement, then you end up in the fallback method where you essentially make an adjustment to the rules of one of the other bases of appraisement in order to try to find a value that's going to work. Okay, so I want to get into transaction value because that's really where I'm focused. Those other bases of appraisement, I could spend hours talking about those as well, but transaction value is essentially probably 95% of the imports into the U.S., so that's the most important and affects the broadest group of people. And really, it's the price actually paid or payable when sold for exportation in the United States, plus certain statutory additions. So the first part I want to break down in there is the price actually paid or payable. And that's the total payment for the goods, whether direct or indirect, and that's paid from the buyer to the seller, or really a related party to the seller as well. There's one key court case, my favorite court case of all time. I don't know what Michelle's favorite court case is, but my favorite court case is Genera Sportswear. In that case, CBP said that the customs service at that time doesn't have to do extensive fact-finding to determine what payments are related to the goods or unrelated to the goods. The burden of proof is actually on the importer to prove that any payment made from the buyer to the seller is unrelated to the goods. Otherwise, all of the payment from the buyer to the seller will be part of the value under transaction value. So all of those payments have to be included unless you can prove otherwise. So it's a very important court case for customs. And importers sort of have a relative disadvantage where you have to substantiate anything you're going to exclude from the valuation.
You mentioned some additional payments. What are some examples of those additional payments that you see in audits these days?
Well, most common is tooling, right? Like everyone that imports something that's made in a mold or made with tooling or made with machinery, a lot of times those suppliers may charge an upfront setup charge, tooling charge, whatever the case may be. And I'm sort of distinguishing this from assists a little bit because there's a different way of valuing assists versus valuing payments, right? If you're making a payment to a supplier, it's technically not an assist. It is a payment, part of the payment. And so we see these kind of charges all the time. Material acquisition charges is a big one. A lot of surcharges in like the metals market sometimes. Spot buys, like, maybe you forecasted you were going to produce 100,000 units or need 100,000 units produced, but you actually need 500,000. The supplier says, yes, we can do that for you, but now we're going to have to go buy materials in the spot market, and we're going to have to charge you a surcharge. Those types of payments are related to the imports, and you have to declare them. A huge one with related parties is related party transfer price adjustments. If you are importing from a related party, there is a good chance you have a related party transfer price adjustment if one of the entities within the transfer pricing agreement is not falling within its target operating profit margin or whatever set up in the agreement. So there are a lot of times for tax purposes, they call it, right? We're going to make an additional payment to our related party supplier because we made too much money in the U.S. For tax purposes, we're making too much money, so we need to remit part of that back to the supplier. Well, that adjustment becomes part of the value. You'll have tax people all day tell you, well, that's just for tax purposes. That doesn't mean anything. For customs purposes, it's important, and it's part of the value. Also, sometimes we see advance payments or milestone payments. Milestones are typically paid when there may be an agreement with the supplier. If a good achieves like a certain certification, they may have to then pay an additional amount based on that certification or achievement. And a lot of times what happens is when we're talking about all of these kind of payments that we're talking about, right, an importer may not know them up front or know them at time of importation. And so a lot of times importers have to flag their entries for what's called value reconciliation, where they would then have to, basically you could flag an entry for value reconciliation, and you have 21 months to true up the value essentially for customs purposes. And I'll talk a little bit more about that later. Other things, big one, non-recurring engineering or design fees. Another big one. Engineering is a big value addition. And customs kind of knows these things, right? These are the things they look for when they do audits. Okay, one of the other elements of transaction value is there has to be a sale for export. It's basically a transfer of title or ownership from one party to another for consideration, usually money, right? And in order to have a sale for export to the U.S., the goods have to be destined for a U.S. customer at time of importation, or at time of the sale. So where this kind of becomes important is within multi-tiered sales outside the U.S., also known as for the first sale rule, which is based on the Nisho EY CIT case. And it gets a little complicated, but I just wanted to introduce the topic here, and I'm going to cover first sale a little bit later. But the key thing you got to remember, to be within transaction value and even fit within first sale, every sale has to be a sale for export to the U.S.
John, I know that you mentioned first sale rule, which we will discuss a little bit later. Do you have any other strategies that importers can take to reduce their import value?
There are some that you can take. One of them being there's certain statutory exclusions, but which I'm going to cover in a second. But the biggest, well, not the biggest one, but kind of a more prevalent one that's occurring now are what we call like these unbundled, the unbundling of the price or a separate charge for management or service fees. And I'll just say right now, there's a lot of importers trying to tackle this concept to see if they can exclude a portion of their value from the dutiable amount, right? And what I'll just say up front is it's very difficult to do this. However, there are rulings out there, and if you look at the Valuation Encyclopedia and look up management fee, you could find some of these things. But I'll give an example. Say you are importing from the parent company, and the parent company is centralized globally the accounts payable function for the entire world, right? Every related affiliate pays that entity for accounting functions. Now, in that case, that accounting function, accounts payable, is unrelated to the actual imported goods. So you can make a case that that payment could be excluded from the value. This kind of falls within what we're saying with genera. Is like you have to prove it's unrelated to the goods, right? And so if I can prove it's related to an accounting function that has nothing to do with the actual importation, then I can potentially exclude that service fee from the value. If a bunch of requirements are met, it has to be paid separately, the importer has to book it a certain way. But the most important thing is you have to have access to the seller's accounting records so you can prove the fee they're charging you is tied to actual expenses in their books. Otherwise, CBP will say, you can't substantiate it, you cannot take it. It's a very high burden, and I would recommend anyone doing this to reach out to their legal counsel to make sure what they're doing is correct, because CBP is going to be spending a lot of time on this over the next few years.
Yeah, as we are talking, we received a comment that there's some audience are experiencing some disruptions. So don't worry about it. This presentation will be recorded, and we can send you the presentation recording in the next few days, as we announced at the top of the hour, in the beginning of the hour. John, so just to get a better understanding about the management fees on bundling, would the importer be allowed to get some markup fee on top of the actual service fee or management fee? How does that work?
Yeah, I think that's a good question. So can a seller make a profit from charging a fee for like accounting or advertising or one of these functions, right? What I'll say is the rulings that I've read on this topic have allowed up to, the biggest one I saw was a markup of 15% on the service that they're providing. So there is some wiggle room for including some profit related to that service fee. However, I think, I'm not saying you could always include 15%, right? It's based on the specific circumstances, and that fee has to be at an arm's length, and there's lots of other things going on. But there is some wiggle room in there to have a profit on the service that's being provided. And where customs has said, yes, none of that's not dutiable, or none of that payment is dutiable, sorry. Okay, other exclusions. These are kind of more of the low-hanging fruit items that that we've traditionally dealt with more often. International freight being a big one, right? That one's a slightly more complicated, and I'm going to talk about that over the next couple slides. But some of these other ones are a little more straightforward. Post-importation charges are specific. There's a certain list of post-importation charges that can be excluded from value if it's included in the price, right? The first thing is it's got to be included in the price to begin with, right? But for post-importation, it has to be services that are going to be provided after importation. And it usually relates to construction, assembly, maintenance of some of the imported items. And we most often see this in more like project-based imports, where what you're importing is maybe like a plant or a gigantic device of some kind, where part of the price includes assembly and maintenance and putting together that piece of equipment in the U.S. after importation. If you can break out those charges separately, you can exclude them from the value because it's related to a service being provided after importation.
There's a important concept that I want to kind of highlight here. John, you mentioned milestone payments a couple of slides ago. Those milestones sometimes may happen after the importation. So how does that milestone payments differentiate from some of these post-importation charges that importers are allowed to deduct from the transaction value?
Right. I think that's a very good question, because when we're talking about post-importation charges in the context of an exclusion, it's specifically related to these services being provided in the U.S. after importation, and it's a very limited list. It's construction, assembly, maintenance, erection, basically construction type things. Whereas any payment that occurs after importation is considered by customs part of the price actually paid or payable, right? It's a payable amount, and it's differentiated between this. Even if it's charged after the fact, it's still part of the payable amount. The post-importation charges in this instance very specific to those functions.
Yeah, that's a great way to distinct the two payments, and because they make a huge difference in terms of the transaction value, total amount.
For sure. Some of the other deductions. Transportation after merchandise, if you were importing on like a CI or a DDU term, for instance, there's going to be some domestic freight built into that transaction. Depending on your Incoterm, you may have some U.S. domestic freight. And the one thing I'll say about U.S. domestic freight is you can deduct the usual amount. It doesn't have to be perfectly actual. The rules for customs say you have to deduct the usual amount, which is different than what it is for international freight, which I'm going to cover in a second. And the last one, if you're like a non-resident importer, you may be importing DDP for a customer, then you'd be able to back out any duties paid and stuff like that. But that's not all that common, but we do see it, right? You'd want to definitely be able to back out the duties in today's world because every dollar matters in terms of duty.
Totally.
So on international freight, this is I think it's a very easy concept, but it's one that's often overlooked. But international freight can only be deducted to the extent that you can actually provide third-party documentation to substantiate that was the freight charged to your supplier. So if you're importing on a a CIF term or a CIP term where there's an amount for international freight built into that price, you can only deduct that international freight portion to the extent that you could substantiate it. And by a third-party record, I don't mean the supplier. I mean what the supplier paid their carrier. So you need documentation from the carrier in that instance to substantiate it. And you don't have to trust what I'm saying either. CBP's got a good informed compliance publication on this called The Proper Deductions of Freight and Other Costs from Customs Value. That one is very clear. It explains the freight deductions. And, going back like a year ago, freight, it's like, okay, you failed to deduct freight, you owe an extra 2% of your freight cost because that was the average duty rate, right? But now, if you're importing steel and there's freight built in and you can't substantiate it, if you have $100,000 in freight over the last month and you can't substantiate it, you have to apply 50% duty rate. It's a big deal now. It's a very big deal. And I guarantee you CBP will be looking at these low-hanging fruit items like this. So make sure if you're deducting freight that you can get third-party records from the carrier to substantiate that's what they're billing. Because most of the time, freight's estimated, right? Your supplier oftentimes, like, not only may estimate it, but they also may mark it up, right? And you can't deduct marked up amounts of freight. So it's an easy target for customs. So make sure, definitely you could substantiate it.
Yeah, I was in the audit meeting a couple months ago. The custom auditor, the first thing they looked at is like, okay, you deduct the international freight. Can you show me some records? That's a very easy question for them to ask and spot on the form. So that's it's a simple point, but it's actually very critical.
Yeah, and with duty rates what they are now, every dollar matters. Okay, and here's one that often gets mistaken: foreign inland freight. Okay, depends on your term, right? Like if you're bringing something X works, that means you're arranging for the freight as the importer, and you're not actually paying the supplier. So foreign inland freight is a moot point. But if you're importing on like FOB or anything after that, any C terms, D terms, you cannot deduct foreign inland freight unless those charges are identified separately and you have a through bill of lading. Most of the time, that trucking piece, like if you're importing from China, the trucking piece from the factory to the port of export is usually on a separate bill of lading, separate carrier, all that stuff. You can't make that deduction. Foreign inland freight is a tricky one, and even if it's identified separately, if you don't have a through bill of lading and can't substantiate that, you cannot deduct it. So most of the time where we see foreign inland freight being deductible is when you have, like, say you're bringing something UPS, right? UPS picks it up at the dock, delivers it all the way here to the U.S., right? It's all built into the price. In that case, it's one through bill of lading. But on a lot of these ocean shipments and a lot of things like that, you don't have a through bill of lading, most likely.
Mm-hmm.
Okay, so those are the deductions. Now we got to talk about the additions, which is separate from the separate payments, the supplemental payments. There's all these other categories of statutory additions that get captured: selling commissions, royalties, assists, packing, and proceeds. So first one, selling commission. So in this case, we're distinguishing between selling and buying commissions, and really what we're talking about is a middleman in the transaction, right? We're not talking about your sales force making commissions on sales. We're talking about a middleman involved between the seller outside the U.S. and the U.S. importer, right? Some companies have buying agents, some factories have selling agents, but essentially what it comes down to is if that agent is working on behalf of the importer, most often that will be considered a bona fide buying agent agreement, provided it meets certain requirements. But if that entity is working on behalf of the seller, it's part of it. It can often be part of the value. But a lot of factors that go into play: is there a written agreement? What activities is the middleman doing or agent doing? And then they would look at the totality of the circumstances to determine whether it's dutiable or not. But typically, the distinguishment: selling commission, dutiable; buying commission, not dutiable. But there's some nuance to that, and there's lots of rulings out there on this topic.
For sure.
The second one, royalties. See this quite a bit. Was related to intellectual property. A lot of times, as a condition of importation, you may have to pay a royalty to the seller. CBP applies this three-part test to determine whether it's dutiable or not. And what I'll say is, typically, if we're talking about a royalty that's related to a patent or production of the imported merchandise, it's going to be dutiable. But if it's related to a trademark, CBP often considers that like a selling expense, and it most likely will not be dutiable. However, I will say, if the royalty is paid to the seller, more often than not, it's going to be dutiable, because it's part of the price actually paid or payable. But royalties are reviewed on a case-by-case basis. They're easy, low-hanging fruit for customs, because customs is going to look at your general ledger when they do an audit, and they say, let me look at your general ledger. They look for royalty expense accounts. They look at the detail, and they say, okay, give me all the agreements that pertain to these royalties. And they're going to be able to easily identify that in your accounting records and during an audit. But each one is dependent on the circumstances. There's this three-part test that you can kind of look at to kind of see if your royalties are part of the value.
Yeah, great tip.
Okay, assist is the biggest category of additions, I would say, that we often find, either whether I was at customs or now being an external auditor or consultant that helps companies, we see assists all the time, right? And it's really any of the following list of 4 items that are supplied directly or indirectly, free of charge or reduced costs by the buyer. So category 1 being materials, components, parts, anything that's incorporated into the merchandise. So if you could see me on camera, right, I have this mouse in my hand because I'm old school and I can't use a touchpad, right? I need a mouse. So if I'm getting this mouse manufactured in, I'm making it in Mexico, and I say, okay, I'm going to provide the mouse wheel, the case, the circuit board, everything that goes in there, and I provide it to the factory and they do assembly. That would be considered a category 1 assist. I'm providing the materials free, they assemble it, and we re-import it, right? Those components need to be included in the value. Category 2 is tools, dies, molds. In the same example, say in the case of the mouse, maybe I only provide I provide a tool or a mold that's used to make the outside case of this item. That mold would then be part of the customs value of this mouse coming back in. You would do an apportion calculation. I'll go into that in a second. Another example is category 3, where you have merchandise consumed in production of the imported merchandise. So maybe when I provide all my plastic material to mold this mouse, while they're molding it, they lose some of it. It gets scrapped. It goes to the floor and thrown in the garbage. That scrap material, if consumed in production, is still part of the value of this mouse, even though it doesn't show up on the mouse at time of importation. That's also a value you need to include. And finally, let's say I wanted to design this mouse and I put it and I outsource my engineering to a firm in Germany that designs the ergonomic settings on it and all this stuff. Those plans and sketches and engineering necessary to produce my mouse, say if I paid $20,000 for design of this mouse, that part is then part of the value upon when I import the mouse from Mexico. So those are the 4 categories of assists.
I would comment this assist concept as particularly important in the now times that where people are talking about restructuring the supply chain. When you have you're shipping the raw materials that from China to another countries like Germany, and for assembly or for reforming and shaping, all of these materials, tools, and everything that you have to ship to Germany to facilitate the production there will have to be counted. And this is pretty critical for us to remember. All these matters will have to be considered and included in transaction value depending on the situation. But I think this assist concept cannot be highlighted more enough for today's webinar.
Yeah, I totally agree. And really what I see most often is the one that kind of creeps up on most people is category 4, the engineering, because a lot of times now companies have outsourced their engineering to India or Southeast Asia somewhere where engineering is a lot cheaper, right? And so all the design work now that's necessary to produce the items is occurring outside the U.S. So those dollars spent that are necessary for production now become part of the dutiable value. And I've had clients that, when we have this conversation, they're like, well, I have $50 million a year in engineering that I haven't been declaring, and it's like a big deal. And in today's world, like any amount of value that you need to add or fail to add is a significant impact with the duties we're dealing with right now. So in terms of valuing the assist, one of the key things that why I distinguish between payments, like you're paying a tooling payment to a supplier versus I provided them an assist. If you provide the physical assist, say you paid a third party to produce an assist for your manufacturer, also within the value, you have to include the cost of transporting that assist to the place of production. So where I'm making a payment, there's no freight, right? But where I'm shipping something to a supplier, and providing them an assist, I have that freight component as well. And usually CBP, that's an easy one for them to look at. Okay, you're declaring assists, that's fine, but what about the freight on those assists? And it often gets overlooked. I think there is one other thing I wanted to talk about here with respect to assists, and that's the apportionment, right? A lot of times when we're producing an item now, especially in this day and age, like if I have upfront costs of engineering or something, I may not want to declare it all this year with the duty rates being as high as they are. A lot of times historically, we tell companies, hey, you're paying 0% or very low duty rate. Just declare it on the first shipment. It's done. You don't have to track it. You don't have to worry about it. It's over with, right? But now, with duty rates being as high as they are, it may make sense if you have a significant assist expense, like especially on the engineering side, you have to, declare $10 million in duty. It may make sense to apportion that assist over the number of units being produced. So maybe it's anticipated productions over the next 5 years or something. You can apportion that assist on your shipments going all the way for the next 5 years, where hopefully duty rates will be lower. Otherwise, I'm going to lose all my hair, right? So
that's right.
So, but it's an important factor. I think that's more prevalent now than it was a year ago. Like everybody was doing it up front before. Now it's like, well, maybe we should think about apportioning it. And obviously, there's some tracking mechanisms that have to be put in place and some additional controls to make sure you get it right if you're going to do that. But it is a way to maybe, if not even if you have to end up paying the duty on the whole thing, maybe at least defer some of that duty over the next few years. Packing costs, pretty straightforward. I'm kind of going to skip over this one. I've had it added to this slide so you have it for reference. But any packing costs that you're incurring to get the goods ready for importation in the United States, if you're paying the seller, you're paying a third party, that packing cost has to be declared as well. The last one, proceeds. This one's like not that common. And usually this sort of gets included in the royalty piece anyway, because most of the time when you're importing goods from a seller, you haven't made an agreement to remit like 10% of the profit to them, unless there was some royalty agreement where you're paying them for intellectual property or something like that. That proceed usually just isn't that common. So I have the rules out there so you can look at it at your leisure, but I don't want to spend a lot of time on it because nothing usually gets defined as a proceed at the end of the day. It usually gets captured either as a payment to the supplier or a royalty. Okay, so we talked about all the stuff you got to use in transaction value, the rules regarding transaction value, but there are some limitations on the use of transaction value. Some things that will throw you out of transaction value, besides, one of them being if it's not a sale, you can't use transaction value. But one example is if there's a restriction on the disposition or use of the goods. Like if the seller says you have to sell it for this price and you have no other choice kind of thing, or you can only sell it regarding meeting certain requirements, that could potentially throw you out of transaction value because it's a factor that you can't technically quantify for customs purposes. And that kind of wraps up 1 and 2. But the most common one we're talking about with regards to transaction value is if the buyer and seller are related and the relationship affects the price. So I have the regulation cited there to say who's related, but the key examples is if you have a company that's directly or indirectly owning, controlling, or holding with power to vote 5% or more of the outstanding voting stock or shares. That's a very low threshold. So a lot of companies are considered related upon importation. And when you have a related party transaction, you sort of have to prove certain things in order to show that your transaction value is acceptable.
So, John, you just mentioned transfer pricing studies. Can you kind of tell us a little bit more about how CBP generally views them and how that correlates with the importer's burden to substantiate that the related party valuation is acceptable?
Okay, good question, because we get the same question a lot from importers, right? They're like, I have a transfer pricing study, PwC or Deloitte or whatever accounting firm did our transfer pricing study, and it says we meet all of the Internal Revenue Service requirements, so we're good to go. Like we have it, it's approved, we don't have to do anything else. Well, that's not really true. because there's this informed compliance publication, which I recommend you. If you have related party transactions, I recommend it to you. It's an easy read. It's determining the acceptability of transaction value for related party transactions. The key things that CBP said in there is the mere fact that you have satisfied the requirements of the IRS rules does not mean that transaction value is acceptable. It's still necessary for you as the importer to analyze your related party sale to ensure it meets a circumstances of sale test or a test value, which you're never going to get a test value. I'm telling you that right now. But you have to pass the circumstances of sale test. And an importer that relies solely on that transfer pricing study without doing the circumstances of sale test would not be exercising reasonable care. They specifically put that wording in there. So basically they said, if you have related party pricing and if you've never evaluated it, if we think it's wrong, we can penalize you because we're specifically setting the bar that if you don't, you're not exercising reasonable care. So there's these 3 circumstances of sale test that you can use to substantiate related party pricing. And I'll run through them really quick here, but they're not, I mean, there's a lot that goes into this. I can do a 2-hour session just on related party pricing, but you have these 3 tests you can use beyond test values, which I mentioned earlier. So Customs says you can use these test values. I'm just going to say you can't use test values. It's not practical. I've never seen them accepted almost ever. So even if you look at the Valuation Encyclopedia on test values, you'll find all kinds of rulings why CBP said the importer couldn't use the test values they came up with. So it's kind of like a fool's errand trying to even use them for the most part. There could be exceptions, but for the most part, there isn't. So you're stuck with one of these 3 circumstances of the sale test. One being the price was settled in a manner consistent with the normal pricing practices of the industry. So that one's sort of like a 2-pronged test. The first test is like, say, I settle my value based on the London Metals Exchange value as of 30 days from the date of exportation. You know, that's sort of like a consistent industry pricing practice, and it's based on an exchange that's outside the control of the 2 parties in the transaction. That would be acceptable for customs purposes. The second prong under there is you can do a transfer pricing study for customs purposes, where you would compare your profits on the sale to the U.S. to the profits recognized by comparable companies that sell goods of the same class or kind as that of the seller. So they would basically say, hey, I make 10% on the sale to the U.S. If I look at comparable companies selling the same thing in the same country from which the seller is selling it to me, and I could show my profit falls within the interquartile range of that industry, then it could be acceptable for customs purposes. The issue with that is that test is usually very expensive. You have to do a lot of analysis. You usually need an accounting firm that has access to that data. So that's option 1, which is that 2-pronged test, right? Option 2 is very straightforward, and is that if the related party is selling to other importers in the U.S. who are unrelated at essentially the same profit, like the same markup. They sell to you at cost plus 20, they sell to other unrelated entities at cost plus 20. That's usually not that common because a lot of times the U.S. entity wouldn't exist if it wasn't the distributor for that related entity, but every once in a while we do see that, and that would be another way of proving that your transaction value is acceptable in your related party transactions.
So John, we have to...
Yeah, go ahead.
Sorry, go ahead.
Go ahead, Michelle. I get talking fast, I know.
No, it's okay. I would just try to mention that we received a couple questions. Some of them we will address at the end of the presentation because they are not strictly related to some of the topics today. But we have received a timely comment about the profit in the related party transaction value. So here's the question. Can we, so hello, John and Michelle. Thank you for the excellent seminar. Thank you for the kind comments. And I have the question about the profit for the related party transaction value. What is acceptable profit amount?
Okay, that's perfect. That leads perfectly right into circumstance of the sale test 3, which is really you compare the profit on the sale to the U.S. to the parent company's profit globally on goods of the same class or kind. So to put this into perspective, right? Let's say on the import transaction to the U.S., there is a profit of 20%. The seller makes 20%. But if we look at if the parent company's sales on that segment of goods of the same class or kind, let's say the parent makes 25% or 30%. In that case, when we do that comparison, you wouldn't meet the test for customs purposes, and you'd have to use either test 1 or test 2 to meet the test. If the profit was 20% or below, then you've essentially met the test, and you can prove that your related party transactions are acceptable for customs purposes. Usually test 3 is the most common because it's not super easy, but it's a lot easier than test 1, like where you have to go get a study. So that's usually where we fall. And one of the things I'll just mention is that you only have to pass one of the tests. You don't have to pass all 3. You don't have to pass 1 and 3 or anything like that. You just have to be able to substantiate one of the tests, and then your related party pricing is acceptable. And if you can't substantiate it, then you have to go back to that basis of appraisement hierarchy I talked about earlier and go to the next basis of appraisement and see if you can appraise there.
So, John, you mentioned ways like how an importer can substantiate their related party pricing with the 3 tests. Can you speak to how related party pricing actually relates to first sale?
Okay, we're back to first sale. So a lot of times when we're dealing with first sale, right, we do have related entities in the transaction. So of my basic example here, I have the manufacturer and the vendor and the importer, right? And a lot of times in first sale, all 3 are related, right? And in that case, when we're talking about related party pricing, each sale has to be able to meet a circumstance of the sale test technically for you to be able to use first sale. So emphasis is most made on the sale from the manufacturer to the vendor. Because like in this example, right, when we're talking first sale, the manufacturer sells to the vendor at $100. The vendor then sells to the importer at $150. For customs purposes, if we could substantiate that the sale between the manufacturer and the vendor is a bona fide first sale, then our value at time of entry can be the $100, right? We're saving $50 of dutiable value in that transaction. But on that first sale has to be at an arm's length price if it's related, and if it has to be able to meet one of those circumstances of the sale tests that I talked about in the previous slide. Some of the other requirements you have to make, like early on, I said each sale has to be a bona fide sale. So you have to have a bona fide sale between the manufacturer and the vendor, and a bona fide sale between the vendor and the importer. The thing I'll say about bona fide sales is CBP has put a very heavy emphasis on whether or not the middleman is actually a bona fide seller, because there's this issue that we call flash title. It's also called simultaneous passage of title if you look in the CBP Informed Compliance publication on bona fide sales. But essentially, if the vendor never has title to the goods or bears risk of loss in the transaction, there are additional criteria that have to be met for that still to be considered a bona fide sale. Because like the vendor is just like a pass-through, and like the manufacturer takes the risks up to the point of export, and then the importer takes it from the port of export up to importation. That vendor never really had title or any risk in the transaction. They're just basically cutting some of the profit out, right? So there's additional elements you have to prove to make that. But CBP, I've heard the field director of Long Beach say specifically they're emphasizing the bona fide sale from that middleman, that there is a bona fide sale to that middleman.
Is there some records that an importer must must prepare for an audit from CBP? Because for lack of a better word, some of the comments that I receive often is that the first sale, custom hates it. Do you agree with that statement?
Yeah, hate's a strong word, but I think they put a lot of scrutiny on it because there's a lot of companies that use it that they don't actually qualify for first sale. They just say, oh, well, we have a manufacturer and a middleman and an importer. We're just going to use the first sale, when there actually isn't actual sales taking place. It's just essentially like a duty dodge in that case. So you have to meet the requirements. And if you are using first sale, you should have a documented process. It should be all mapped out. make sure you meet all the criteria, and I recommend you get legal counsel to substantiate what you're doing. You could also consider a ruling. But what I'll say on the ruling side is CBP has been very strict on their first sale rulings lately, and they're finding anything they can to try to throw the importer out of using first sale. They've been very strict, like unusually strict in my opinion, but I think that's the administration that we're dealing with right now. The customs, they're trying to maximize revenue. Before I just, the one other thing I wanted to say about this, you have to meet all of these criteria on here. So you have to have the bona fide sale. It has to be clearly destined for the U.S. at the time of the first sale. The first sale must be an arm's length price we talked about with related parties. And then the other thing, all those additions to value I talked about earlier, those, if the importer or the vendor or any entity in the transaction is providing an assist to the manufacturer, you have to make sure you include those. Because if you fail to include those, CBP could use that as a basis for negating your first sale and say, you didn't declare certain additions, so we are saying your first sale is unacceptable, and we're going to go with the second sale price. So make sure you consider additions to value. Okay, so just a few more slides left. One thing I do want to mention is about customs value reconciliation. A lot of importers are using this program now, but it's not to be taken lightly. There are lots of things that I talked about with respect to additions to value, like assists and supplemental payments and milestones, like Michelle was talking about. Some of those things you may not know at time of importation, and you just can't know because they may occur later. In that case, you can flag your entries for what's called value reconciliation. You guys have to have a value reconciliation bond writer to do it. And then you can instruct your broker to flag entries for value reconciliation. And then you have 21 months from the entry summary date to reconcile those entries. The one thing I'll say is, like, once you flag, you have an obligation to reconcile. Even if there is no change in value, you have to file what's called a no change reconciliation. So no matter what, you have to file. And if you don't file, or if you're late, you will get a liquidated damages notice from customs. They automatically come every month once they start going late.
That's all excellent content. I know that we still have 2 slides left for internal controls. I do also want to leave some time for us to address some of the questions that the audience flagged for us. So we'll skip those, but you can see the PowerPoint slides after the program. Those slides and bios, our bios can be downloaded, in the related content section in the control panel. So now let's dive in the 2 questions that we received here, John, so
Sure.
that we give them some time. The first one is that, let's do it backward. There is a question asking us to comment on the validation of the portion of steel in derivatives.
Yeah, I knew this one was coming, and I deliberately didn't put anything in my presentation on it, right? So no, but it's a fair question and a good question, right? I think the latest guidance I have seen on the valuation of steel derivatives, the steel content, whether you're talking about steel, aluminum, copper, whatever, CBP has essentially said the value from the value is the cost incurred by the importer for that steel content. So if the steel represents 20% of, let's say, the BOM value of that item, that is the value of the steel. I will say that CBP gave some conflicting guidance prior to that said you could base it based on what the supplier paid for the steel. Now, I don't have a specific answer of what is the correct answer because CBP has not published what is the correct answer. The FAQ is currently silent to that effect, other than their generic language, which is kind of just cites the value regulation, right? But they're not clear as to what the value should be. So I would recommend that you contact your legal counsel to get a legal opinion on what value they should be using, because it is not currently clear from customs. I anticipate getting something published. They should publish something maybe when the government shutdown ends, because the FAQ page is currently not being updated during the shutdown. But there was definitely intention prior to that they were going to publish something in the FAQ soon. Do you have anything to add on that, Michelle? I mean, you experienced this too. Is there anything else you think we should say about that?
I think that I totally covered it. We have another question that one of the audience has submitted, which is, I have a client that produces a medical device manufactured in China. Sometimes he doesn't receive his shipments due to orders getting snapped by customs. Are there any forms that will prevent this? I can speak to this. As a matter of fact, I was just dealing with some similar detention in the recent weeks. There is not much at all a form that can prevent this, but more like, what can you do to proactively to avoid this from happening? First is that you would like to get a clear understanding about whether your product that's being imported to the U.S. Complying with FDA's regulations before you ship the products to the United States. For example, does the product already receive a 510K approval or some other pre-market approval? Otherwise, you will need to upload those documentation to FDA's ITAC system by your custom broker. And you don't want to get detained and then starting to explain yourself, after you receive the detention notice, because it got tricky, right? First of all, you got, like you said, you will get snapped and you will impact your timeline for sales. The other thing is that when you have too many of those detention, your shipments, your company will likely to be bumped up on the FDA's list. So the likelihood for your shipment to be detained by FDA is actually increasing. To make a clear map of the compliance, like a status of the products, is very critical. And when you have to get to a situation why all the time the shipments got snapped by customs, that's likely because the producer's name or the consignee's name or the importer's name was actually flagged by FDA due to the previous, some failures or refusal of entry or detentions, all those historic records. And we can talk about this, all day long after this program, and we're happy to address your further questions. However, this is not quite related to today's program. Even so, it's still very important to get those all the flags being cleared out before shipments. So I think we are almost at the top of the hour. John, do you have any additional comments before we end today's webinar?
No, I'd just like to thank everyone for their time. I know everyone has a ton on their plate in the new trade environment, so I appreciate you all taking the time to sit in today.
Yeah, at the end of it, I will stress and highlight again that we invite everyone to stay abreast of the continuing trade developments via our trade blog, Thompson, Hine, SmarTrade.com, to receive an email notification. If you haven't already subscribed to it, please subscribe to our blog. Appreciate your time today, and a check-in code will be announced at the end of the program.